And let's unpack this because I want the listeners who are listening to this podcast right now to have the perspective of Japan. The Japanese think about things a little differently than us Americans here. We are thinking 90-day cycles. We're thinking 2 or 3 months. We're thinking, oh, 2025 is maybe the right time to buy or to sell. They think in 100-year cycles. If you had a longer time horizon, my question to you is, would you buy real estate? If you knew that you're not going to sell for 50 years from now, would you even care, right? And so that may be too long a time horizon, but any real estate that's been bought anywhere in the world 100 years ago is worth infinitely more now. If time heals all wounds in real estate, then if you want to hack that and accelerate that, then it's even buying in different strategies and different economic cycles. And that's what we've been studying at Viking Capital in our laboratory.
Welcome, everybody, to a brand new episode. In the fast-paced world of multifamily investing, the ability to swiftly identify, analyze, and pounce on lucrative opportunities is what separates the wealth builders from those that are left waiting on the sidelines. This episode is a masterclass in developing a razor-sharp deal acquisition strategy, one that allows you to capitalize on prime multifamily investment opportunities before they vanish into somebody else's portfolio. Whether you're a seasoned investor or just starting out, this is a can't-miss blueprint for consistently outmaneuvering the competition and building lasting wealth through real estate. Today, we're joined by Vikram Raya, CEO and co-founder of Viking Capital.
Thanks for having me, Nathan. I'm really excited to be here, buddy.
Yeah, absolutely. This is going to be a great episode. So, Vic, can you kind of describe the importance of really, transacting across different market cycles? Because a lot of people will try to time the market rather than have time in the market, and they're going to be waiting on the sidelines, waiting for the right opportunities. But what's really the power of having that kind of transaction machine consistently running?
Nathan, you're asking some really good questions, and let's unpack this because I want the listeners who are listening to this podcast right now to have the perspective of Japan. So the Japanese think about things a little differently than us Americans here. Right? We are thinking 90-day cycles. We're thinking 2 or 3 months. We're thinking, oh, 2025 is maybe the right time to buy or to sell. They think in 100-year cycles. So if you had a longer time horizon, my question to you is, would you buy real estate? If you knew that you're not going to sell for 50 years from now, would you even care? Right? And so that may be too long a time horizon, but any real estate that's been bought anywhere in the world 100 years ago is worth infinitely more now. Do you agree?
Yep, absolutely.
So if time heals all wounds in real estate, then if you want to hijack that or you want to hack that and accelerate that, then it's even buying in different strategies and different economic cycles. And that's what we've been studying at Viking Capital in our laboratory. And it's in our deal analysis laboratory with you as our senior associate of acquisitions, with our vice president of acquisitions, Judah. We go through about 2,000 deals to find the 5 to 6 that makes sense. So that diamond in the rough, if you will. However, our strategies have shifted based on the economic cycle, right? We have to be extra diligent during what we consider right now. We're probably in early buyer's market phase 1.
Yep.
And so there's economic cycles. There's buyer's market phase 1, phase 2, seller's market phase 1, phase 2, right? And back in the day, before the Fed was so interventionary, you could sort of predict things, based on characteristics of the market. But now, they'll throw up a chart, I'm sure, in the middle of the episode where they can show those market cycles. And we probably have a free PDF or download that they can get from us to do that. So guys, at the end of the episode, if you want that PDF of all 4 market cycles that Viking Capital looks at and the characteristics, this will help you perform in this cycle. Please download that. But back to the story. It's not so clear anymore because they can pump in trillions and sort of shortcut or short circuit a typical economic cycle. So Nathan, what are your thoughts on that? And how are you guys navigating that as you look at deals?
Yeah. So for me, that's honestly like the truest definition of generational wealth. If we're thinking in long-term cycles of 20, 30, 40, 50 years, there's going to be a time where the person who's buying that asset isn't going to be the one who's managing or selling that asset, right? That ideally for me would be the true kind of legacy wealth builders that, hey, there are market cycles. We know that real estate is cyclical, but if we're able to continuously buy, to continuously capitalize, and to continuously change our strategy as the market adjusts, one, we're going to, acquire a lot of good real estate, but 2, and kind of more powerfully, is that we'll be able to know the different market cycles and how to perform in each of the different market cycles. So, You talked, Vicky, a little bit about the buyer's market and seller's market. I really want to kind of break that down because there are different acquisition strategies that you should have depending on kind of where the market is and the different kind of challenges that it presents. So in a buyer's market, that is really where kind of the leverage or the power is turned to buyers. So there's typically an oversupply of properties that creates kind of more negotiating power for buyers as sellers face more competition, and prices tend to be lower in a buyer's market. On the contrast, you have a seller's market where the market's at an all-time high, prices are at an all-time high, and there's availability of buyers, but kind of limited supply in the market. So that it's hot, it's ready, it's off the press. So this gives sellers more leverage as they can demand higher prices, they can negotiate better terms, as all these buyers are really kind of biting at the bit, so to speak, to really kind of get the right property because it's so lucrative at that point, right? There's double-digit, like what we had 2 years ago, there's double-digit rent growth, prices an all-time high. Yes, you're buying at the top of the market, but economics at that point in time are solid. Let's talk a little bit about the different kind of buying strategies.
So Nathan, I want to pull back the kimono and I'm going to tell sort of the wins that Viking has had and some of the losses Viking has had in terms of trying to time the markets, right? So we bought, and it's not really a true loss, but there's a deal we had in South Atlanta that we bought. It was a great deal. I think 368 units, and we bought it at the right time. The interesting thing was we're near the end of sort of the seller's market phase 2 where prices were going crazy, but we had just bought it about 18 months ago. And typically we'd like to hold 3 to 5 years, but that would have made sense to sell at that time. And we would have gotten a quick cash out. But we also know that if we miss this economic cycle, we know we can hold it because it's a cash flowing property. Our investors are doing well. We're doing well in it. That now we have to wait for the next cycle. So we're cognizant of the fact that there's certain time periods to sell. And so when you're crafting and constructing deals, make sure you have a long enough runway on your loan so you can choose optimizing and maximizing returns for your investors. And so that was a good experience for us to know that, okay, sometimes you may need to, even if you buy something and then the market makes sense, it's okay to sometimes transact quickly. And the thing is, we know that we can always 1031 into something else. So if profit is to be made and it does make sense, consider sometimes capturing these tidal waves of appreciation and cash out. That being said, we have a person on our team named Ed, and Ed is a very unique individual. The reason why I say that is he's been in real estate, specifically multifamily, for 30 years. And he's seen at least 3 to 5 economic cycles. One of the things he told me is typically he sees 2 years of flat, not necessarily decreasing rents, but usually flat rents, depending on what emerging market you're in. And then about 7-year upcycle. And so that seems to follow what's going to happen here. Like what we had, call it 2023, 2024, probably little down years. And 2025 is probably the beginning of the next upcycle. And the other interesting thing is we look at macroeconomic data and we look at movers, early movers. And in this case, I was reading the Wall Street Journal and one of the main articles was about Blackstone. And as you guys know, Blackstone is a huge private equity company. They're in multiple asset classes, including real estate. And then they just did a $10 billion acquisition of group of assets of all apartment buildings. I was speaking to John Chang of Marcus and Billichamp fame in the Best Ever conference, and he said that he thinks this is the first domino to fall in the next economic cycle. So based on the characteristics that, me and you have studied, Nathan, I believe we are in buyer's market phase 1, but it's early. And I think it's going to become more mature in the second half of this year. And I think the seminal moment is when, it went from 6 rate cuts to 5 rate cuts to 3 rate cuts to, I think we're going to have maybe 1 rate cut in 2024. And we're recording this, guys, in April 2024. So I think we're going to have 1 rate cut, but it doesn't matter how many. The reason why is it's a symbolic movement. The moment that we have a rate cut, that means it's a different cycle, I think, moving forward. And I just love to get your take on that as well, Nathan.
Yeah, 100%. So the whole reason that they were raising rates was to fight inflation. If the Fed, decides to, or I should say when they decide to cut rates, that's a sign to say, hey, we've gotten inflation under control. We've got it kind of in the benchmark that we need it to be in, that kind of 2 to 3% range. And now we're ready to kind of stir up the economy and to get the juices flowing again. That's really where you're going to have, a lot of dry powder, a lot of kind of capital that was sitting on the sidelines really come back and kind of mix in the fold. So I totally agree with you. I think we're kind of at the tail end of buyer's phase 1 and moving into buyer's phase 2. And so buyer's phase 1, that's really when you have a really strong buying market. That's where you have to be, selective in making offers. You have to negotiate pretty aggressively on pricing and terms. You have to look for motivated sellers. And as we move into buyer's phase 2, this is really where you're going to have to act quickly to get good deals before prices rise even further, right? Because you have all the institutional capital that was sitting on the sidelines, competition is going to be fierce. Debt is going to get less expensive, right, with those rate cuts. And the kind of buying power is going to be back in the hands of buyers, where it was kind of a stalemate for a while, right? For, I'd say, about a year or so, there weren't a ton of transactions because sellers wanted prices that buyers couldn't pay with the changing market, and there's volatility. So, I really think this next kind of 6-month window is going to be really the time to buy.
Yeah, I was looking at some data from one of the economists that we work with, and in the worksheet that he had provided for us, he said this is the closest decrease in spread between bid and ask pricing that he's seen this quarter. So what that tells me is there's a lot of leading indicators and lagging indicators. And what I'm noticing is both indicators are starting to line up to where something is about to happen. And if you're not in acquisition mode, you're going to miss out on the sweetest deals. And then you'll have to compete with the general fray with remaining deals. Now, that being said, you'll still have good deals and it will still pencil, but not as much as they do now. And that's why our motto in Viking, I would print t-shirts with this. It would say, hey man, Jerome, keep the rates up, because what he's doing is preventing the institutional players from playing. And what that means is there's groups like us, we're not institutional, but we're definitely not mom and pop. We're sort of that semi-institutional group that is starting to see these opportunities because we've already been through an economic cycle. So we're mature enough to know when there's an opportunity. And that's why we stepped in and took over a deal, and we got crazy economics for that deal we're about to close on in North Atlanta. And then we're doing the same in Austin. We're getting a deal at a crazy basis that's unheard of around Austin. And so we're starting to see these opportunities that we didn't see for years, I would say. And as long as we execute on our business plan, we're going to really ride up that appreciation wave.
Yep. And we noticed that too in kind of the whole acquisitions pipeline, because we were in the market and we were submitting offers and we were talking with brokers, we noticed a shift when we were, 20% off of guidance to 15% off of guidance to 10% off of guidance. So we could see literally that market getting closer and closer to what sellers wanted to ask. And I'd say it's really in the last kind of few months where we've had kind of those synergies between saying, hey, sellers are willing to give some concession, maybe not a 20% discount, but maybe a 10% discount, and buyers able to lock in fixed rate, and it makes a whole lot of sense. It's the same thing with the new deal that we have, that Villas deal. I noticed that deal kind of early on the pipeline as, hey, this is a deal that meets all of our criteria. It fits our buy box to a T in a great growth corridor between San Antonio and Austin. There's a ton of kind of growth coming to that corridor. It's something that we've been looking at for a while. We see the kind of the right opportunity to break into that market. And now that we have that opportunity, let's find a way to make the numbers work. Let's get competitive because it's a deal that can stand the test of time, and we're buying it at the discount before kind of the huge wave comes in the next few months, which sets us up really well to perform well on that asset and obviously assets moving forward too.
Yeah, the thing I'm thinking about is there's two main green flags, I would say, that make us want to buy, or checkered flags that make us want to go. Number one, it's cost basis per deal. Like what's the per unit price compared to replacement value? That's one way for us to evaluate sometimes properties. And these are more for the core plus / value add properties. And for more of the pure value add, then it's more of a cash on cash basis. Hey, can we hit our cash basis year one? For us, we'd love to get closer to the 4 to 5% mark year one. And then we know we can build that up to our returns that we like to give to our investors. So those are sort of the two big things. The other thing is this is the time to capture market share. I was at the Best Ever Conference and I was speaking to a lot of the bigger operators, people who have between $1 billion to about $6 billion of assets under management. And the interesting that they're telling me is they're in pain because they grew so aggressively during 2021, 2022, where they had all the bridge debt, right? And so we also had some of that bridge debt. And this is a nationwide issue. And it's not just us versus them, it's all of us together, but it's how much exposure. I guess the buzzword I would use as an investor to understand who you're working with as a sponsor is, what was your exposure to some of the challenging deals during that 2-year period? The less exposure you had, the more likely you'll be ready to rebound and take advantage of this new opportunity that's coming through. Now, even if you had a high exposure, I would urge those operators to actually lean in and buy their way out of this mess. And the reason why I say that is it's almost like dollar cost averaging. Tesla at its high was, $1,000, right? And then now it's like dropped to 400 or 500. So like, if you believe in the story of Tesla and you believe in that industry dominance and them going to be becoming more of a tech company, an AI company, then you know that this probably is a discount. So you buy on the dip, right? And you're just buying your way up and knowing that eventually this is going to become a multi-trillion-dollar company. So similarly, if you really believe in the story of multifamily, which has been proven in so many different ways. One, Nathan, you told me that how many units shortage are there in the country right now? Do you think?
I'd say probably about 4.5, 5 million.
Yeah. So if you didn't catch what he said, it's not 4,500, it's not 4,500,000, it's 4.5 to 5 million units of shortage. And that's exacerbated by certain submarkets, right? You're talking Atlanta, you're talking the four Texas markets, Austin, Dallas, San Antonio, and Houston, places like Phoenix, like there's Carolinas. These are where Viking likes to look for deals. And there's a ton of demand, there's a ton of growth out of the Californias and the Chicagos and the New Yorks into these places. First started by the pandemic and then continued even today. And so that supply demand mismatch. Plus, it's so expensive to build now, unless you have like a special discount, like which we're going to have on one of our deals that we're thinking about. But otherwise, it's very expensive to build. So new supply is stalled. It's unaffordable to buy a home. It's the most unaffordable it's ever been to buy a home. So then there is a temporary slowdown in rent growth, and then it's going to go back up. And then we're already seeing in some of the markets. So some of the deals we bought, they're actually having rent growth.
Yep. That's the thing too, is like there's this canonical like phrase in investing is, zig when others zag. And that's so easy to say, but it's so hard to actually execute on. And this is kind of the one prime opportunities where when there's blood in the streets, that's when you want to buy property. And so a lot of people have this, recency bias where they think about kind of the most recent event that happened. And, hey, they got burned over by these bridge debt loans where they had high leverage. And even though debt was cheap with the rising interest rates, all that higher debt service ate away at their cash flow. And, they're not focusing on operations. They can't refi, they can't sell. And so a lot of people will choose to not buy because of that fear, because of that, what they just got burned on. But honestly, this next opportunity, again, in this next 6 to 8 months, is going to be the prime opportunity. I don't think we're going to see again for, potentially another even decade or so. This is really kind of going to be the next buying opportunity where the power is in your hands. It's coming down the line. And now, despite all the, headwinds that you faced, all the hesitancy that you had, about a year ago, now's the time to really kind of correct the captain's ship, get the captain's hat back on, and really kind of steer your acquisitions, ship in the right direction. Because even though the storm ahead can be kind of tumultuous, it's not going to be, as rough as it was. Again, if buying at a discount or buying for cash flow are both phenomenal ways that you can build wealth and build wealth quickly. Vic, can you talk a little bit about what it takes to really have a transaction machine? It's easy to say, hey, buy in every market cycle, but what kind of team, what kind of processes do you need to have to really kind of identify the right opportunities and close on them?
Yeah, I'll definitely want to tackle that. So I'll talk about like three different types of buyers. I'll talk about like first time people getting into multifamily. I'll talk about sort of seasoned people, and I'll come up with like an institutional strategy as well. So three different levels. But before that, you mentioned a quote like, hey, when there's blood on the streets, it's time to buy, or something to that effect. Chris Parinello, our director of investor relations, actually said that. He said there's actually a corollary to that saying. He's like, when there's blood on the streets is the time to buy, especially when it's your own. And so I really like that corollary. So maybe some of the best ways for you to capture back investor trust and sentiment, and for those who are hurting on some deals is, hey, dilute the bad deals with the good deals. And the other way we at Viking are saying is you buy your way through this challenge of the economic cycle. So that's one thing. The second thing is some people mistake the poor strategy for a poor asset class. Let's make it very clear. Multifamily is one of the strongest and best asset classes out there. In fact, office was the darling of commercial real estate. When you thought about commercial real estate, it was office. For decades, it is no longer the case. The number one asset class, at least in the United States, I can't speak for the world, but at least for the United States, is multifamily. Where does the smart money, the big money go? It's multifamily now, as evidenced by the recent acquisition. That's important. So change your strategy, but stick to the asset class. And what another thing I've seen is people, smaller operators, I'm seeing this more of, is they get distracted. They're like, oh, let's go do multiple asset classes because I don't know about multifamily anymore. And we're cheering for that because only the strong survive, or only the brave keep moving forward. And when people start getting distracted is when they lose velocity and momentum. And transactional velocity and momentum is important for your credibility in the marketplace, with brokers, with sellers, and with your investors. And now, what are the three strategies to create that scaling machine, that acquisition monster, if you will? Well, if you're a first-time person, this is the best time to get into real estate. So congratulations. And there's two types of people. There are people who are going to buy, sort of small multifamily, 10, 20, 30, 40, up to 50, let's call it. There, you can group capital together, you can get a deal done, and you're going to get discounts. And if you have a little bit of cash flow or a good cost basis and you're in a good area, this is a fantastic time to get in. The next level is the seasoned investors, people like us who are not full institutional yet, but institutional-like, if you will. And we've created an acquisitions team. We've created a marketing team, created an investor relations team. We have a vision for where we want to go. We have a grand vision of a 10-year vision of 25,000 doors, and we think we can get there. But the way to do it is we do 90-day sprints. We implement something called EOS. It's a business operating system within our company. And what it does is it really keeps us grounded and very growth focused, which in this case is acquisitions focused. But we're also playing very good defense. We're shoring up all our deals, that any deals, making sure they're stabilized and they're doing well and they're starting to cash flow. Tight asset management gives you the confidence to know that you can go out and acquire. Next is realizing that, guys, debt is a commodity. And so sometimes you may want to just work with the debt broker that's going to help you win the deal. And the other thing is being aggressive within your scope of capabilities. So when there are times where hard money made sense, you had to put down hard money. In this scenario, there's less need for that. So it's more about broker relationships. And so during all those quiet times where there's no deals being done, it was not like we were staying still. I told Judah, our vice president of acquisitions, I told him 3 words: be on planes. That was it. Be on planes. That was it. And he followed that for 12 months. And now we're having a flood of deals that no one else seems to have. And it's because proximity is power. Being in the same room, breaking bread with the broker, with the seller, with institutions, with our property management company, opportunities come up that are not being broadcasted broadly. And so we're able to get things that are from putting our ear to the ground and hearing things that other people are not. So that's been helpful. Then it's really making sure your equity is there. So if you're a syndicator, great, you can raise the capital. If you're a person who gets institutional money, then by showing them really good lucrative deals, they're willing to co-invest with you. So whatever your equity source is, it's putting constant deals in front of them. And then once you're able to close and transact and do well, and then that customer service, that communication with your equity, whatever, if it's big, small, medium, doesn't matter, that promotes goodwill and they're willing to reinvest with you. And one of the coolest things we have is a high reinvestment rate, almost 65%, which is huge. And the third thing is, if you're an institution, don't be so stubborn and dogmatic. I know everyone has their investment committees and they have to meet all these check boxes, but if there's people who've been through economic cycles, you can taste that there's opportunities out there, and you may want to not wait for everyone to pick up their pencils, and you may want to jump the gun and go after deals that are opportunistic there. It's time to be opportunistic. Otherwise, you're going to still get deals, but the ROI will be diminished compared to what we're seeing now.
I was talking with Ravi about this on a previous episode, and we were saying about having, great offense and great defense. And I was telling Ravi, hey, you don't want a knight in shining armor, right? You want a knight that is marred by battle, who's bloody, who's sweaty, who's dirty, who's able to kind of perform in all different market cycles. And kind of when you just kind of limit yourself to say, I'm only going to buy when things are down and there's an availability of supply, you're limiting yourself to only one buying strategy, right? Which means that if you miss that time period for whatever reason, you have to wait for 3 other market cycles to kind of come and go before you can get back into kind of your zone of genius and buy again. But if you're able to kind of recognize, hey, the market's shifting, which means our strategy is shifting, and you're able to buy in each of those 4 different phases, you'll be able to accumulate a lot more properties, accumulate a lot more wealth, and you'll have properties that you've acquired in different market cycles too, meaning that your defense is also going to improve. So there's really, in my mind, no benefit to kind of waiting and trying to time the market. It really is about how to adapt, right? That's the whole kind of, going back to Darwin and survival of the fittest. Those that are able to adapt the most, those that are able to, find the key for whatever lock, those are the ones that are able to kind of survive and weather any storm.
Yeah, I think if Darwin was a multifamily investor, he would say, grow your company through evolution, not revolution, right? And so really, it's not huge major moves. It's these micro corrections and optimizations over the years that create this massive monumental success wave for a company.
Yeah. We were talking about this at a prior kind of EOS quarterly meeting, where not every deal is going to be a home run, right? You're not going to be a grand slam on every deal. But if you can line up a solid, triple, double, even single sometimes, and get the repetition, get that kind of cadence, that momentum going, you'll be well on your way to kind of closing, 7, 8 deals a year. That's something that I think we've noticed early on in our kind of acquisition pipeline and deal flow, is that momentum is pretty key to our success, right? We know how many deals we have to hit and when we have to kind of acquire them to really kind of be on track for our goals, and to have what I like to call it is kind of a closing circuit almost, where you are closing on one deal and then you're raising for the next deal, and you're closing on one deal and you're raising for the next deal. If you can kind of have the momentum and keep those transactions going, obviously for great deals, that's really kind of the key to having that transaction machine kind of turn and burn through any cycle.
And another interesting thing is, I think giving people some variety provides geographic diversification, but it also gives people variety to learn about different great markets out there. And even though our base is Atlanta, it's been very good to us and we've done really well in Atlanta. It's nice that we're branching out to so many other different parts of the country where there's different opportunities. There's different aspects that we can share to our equity.
Yep. And it helps, create that diversified risk profile too, right? Not all of your investors, all of your equity is going to prefer the same deals, right? Especially if you're working with institutional equity versus retail investors, they're going to have different risk profiles and different kind of needs, and different kind of deals are going to fit their own buy box. So yeah, 100%. Going back to your point about, Ed and his kind of wisdom, he's like, he was talking about new construction and new development. He's like, it's not always necessarily the best time to build from the ground up. But when the right time does kind of present itself, ground up can have one of kind of the biggest kind of equity spreads from when you buy it to when you sell it. Again, that takes a different kind of investor to get comfortable with that deal, but it has tremendous upside too.
Think about it this way. I mean, in 3 years, you get the same result as someone who's doing a typical value add in 5 years. So essentially doubling your money in 3 years is a pretty good proposition that even Wall Street can't ignore.
Yep. And if there are 4.5, 5 million units that are short, someone's going to need to build them, right? That's kind of the only way that new product comes to the market is at one point, all these older kind of value add or core plus deals were at some point the new construction in that market. So that is kind of the beginning phase of kind of all the rest of the deals stems from these new construction deals.
And to be honest with you, if you look at, I don't know the statistic exactly, but it was something like I think 70% of the apartment supply in the United States is like older than 1990s. It's a aged units out there, and I'm sure they've been value added and all that kind of stuff. But that being said, I mean, a lot of things have changed the last 30 to 40 years in terms of construction and capabilities. So there's definitely going to be a need for new housing and new construction.
Yep. I mean, especially when you're thinking, again, going back to the original conversation, like thinking long-term, thinking in 50, 60, 70-year market cycles, all these kind of short-term changes will kind of see themselves out over the long term.
Absolutely, man. So super excited.
Awesome. Well, Vic, you shared some absolute golden nuggets, some wisdom here. Could you kind of give one final thought? Hey, if I'm an investor and I have sat on the sidelines for the past 2 years, I'm a little bit hesitant. What would kind of be your words of advice for them right now, given everything in the real estate market?
I was at a finance meeting in Canada. And then one of the things I learned from that meeting, because there were some notable financiers from all over the world there, including Ray Dalio. And he basically said, you want to have a portfolio construction that's going to have obviously stocks, bonds, but then you want to start choosing non-correlated assets, and real estate should be one of them. Life insurance, real estate, equities, options. You want to have a good portfolio of different things. And so if you don't have any exposure to real estate, that's number one. You should get exposure to real estate. Number two, within real estate, there are a lot of asset classes. There's hotels, self-storage, student housing, mobile home parks, RV parks, and there's all sorts of things. But if you wanted sort of the asymmetric risk reward, meaning the great upside with limited downside, I would encourage you to highly consider multifamily. And the way to do multifamily is either you do it or you work with sponsors or partners that know what they're doing. Either way, it's a win. So, and we encourage a lot of people to consider Viking or other sponsors like Viking that have been around. We're approaching our 10th year in the game. Having a person who's a group or a sponsor that's been through market cycles is very important. And so I would say, and they ask people, some of the wealthiest people in the world, and there's a group called Tiger 21, and it's a quick story and then we'll end here, Nathan. But Tiger 21 is a group of people who have an investable liquidity of $21 million. And that's what you need to join the group. And they asked them, hey, where do they have their money? And it was like, number one was private equity, I think 43%, and like 25% was real estate. And of real estate, it was mostly multifamily. So wow. This is, again, a reaffirmation of where are the wealthiest people in the world? Where are they putting their money? Well, now we know. And so no need to reinvent the wheel, like emulate success. Business, private equity, really what that means is essentially they're investing in businesses, their own or other people's businesses. Great place to invest. Second great place, I would say, is real estate.
Absolutely. Well, Vic, absolute pleasure. I hope to have another episode when we can hop on after the $1 billion mark, because we're on the road there. We're going to hopefully surpass it this year, and then we'll hop back on and kind of go over the lessons you learned through those different market cycles, through those challenges, because it hasn't always been, days in the sunshine. But appreciate you sharing kind of the raw reality of buying through all these different cycles and continuing on. Thanks, Vic.
Thanks, Nathan. Awesome, brother. Thank you. If you like this podcast, please hit subscribe or a thumbs up, and we'll see you next time.